Hello everyone, welcome into Above My Pay Grade. My name is Eric. Thanks for tuning in. If you could hit that like button, hit subscribe, really helps out the channel. Really appreciate it. As I've said multiple times on this channel, I'm just a normal guy trying to muddle my way through macroeconomics because it is very complicated. And you read these articles and you think, what the heck are they talking about? That's me half the time too, and I have to dig into what they mean. But I'm going to read an article here, or read excerpts from an article from MarketWatch that is kind of interesting, something you should pay attention to, and definitely affects you, and definitely shows you that the system is, drumroll please, falling apart. That's right. This is from MarketWatch. It says, this is not QE or QT. This is none of those. Why the U.S. Treasury is exploring debt buybacks. So right off the bat there, the U.S. Treasury is exploring debt buybacks. That means the debt they are selling, they now want to buy. I've talked about treasuries before, bonds on this channel. Treasury sells those, which is government debt, in order to fund the government. And now they want to buy them back. That should set off an alarm bell, right? Why would you sell something and then immediately buy it back? More on this in a second, okay? Janet Yellen worked as the Federal Reserve chair, if you didn't know. And now she's the Treasury Secretary. Something to consider, okay? So further reading here, the U.S. Treasury Department on Friday, this is past Friday, said it plans to start talking with primary dealers in late October about the potential for it to begin buying back some of its older debt to help stave off market dysfunction. Now, why would the market be dysfunctioning? Remember, I've told you, if you're selling debt, right, if you are, asking for a loan, essentially, or selling debt like the government does, the interest rate is the price of that. And if demand goes down for the debt you are selling, the interest rate has to go up. Why does the interest rate have to go up? To incentivize more buyers. It's a simple supply and demand. That is the free market working. The free market setting the price of money. Now, I've said multiple times on this channel as well, why can't the government allow the free market to work? Meaning, why can't the government allow these bonds and these treasuries to go higher in yield? Meaning, demand is going down. That's the preventing market dysfunction. Market is actually functioning very well. Demand is going down for a reason. Why is demand going down? There's illiquidity in the market. The Fed is selling treasuries. Japan selling treasuries. There's a lot of other countries selling treasuries. Why are they selling treasuries? Because they need dollars to buy their currency because it's falling against the dollar. All that to say, demand is very low, supply is very high because people are net sellers of treasuries. So the market is functioning fairly well. It's just not functioning the way they want it to, which means government bills going up. Because if government bills go up, meaning the interest rate they pay on their debt, they are insolvent. So whenever you see market dysfunction, it actually functions very well. It functions very rationally, which is, hey, inflation is 8%. Why would I want guaranteed 2% over 30 years on government debt? I don't think I'd want that. I think I want a higher interest rate to compensate me for the potential risk of sustained inflation. So, oftentimes they obfuscate the truth for that reason. We want to prevent market dysfunction. It functions great. It's just not functioning the way the government wants it to. So they want to provide demand in the treasury market or the bond market where it doesn't exist, and it doesn't exist for a good reason. So essentially, they are no joke, they are selling debt or borrowed money, and then they will use borrowed money to buy that debt. What? Yeah, exactly. how the Treasury buybacks might work. The Treasury asked dealers for feedback on Monday, October 24th, about the new tool to buy back its off-the-run securities. That's older bonds that have been sold. And remember, I did a video on this on the Bank of England. If you have a bond that yields 1%, let's say a 30-year bond, and you bought it for $100, and now those bonds yield 5%, if I'm a buyer, right, and I can go to the market and I can go spend $100 and yield 5% for 30 years, and you want to sell your $100 that yields 1% a year, you have to drop the price in order to incentivize me to buy it. So off the run are older securities that have been sold. Further reading here, it says, as a new tool to buy back its off-the-run securities each year, and it would meaningfully improve liquidity. Translation, meaningfully improve demand. Liquidity is if you go to the market and you want to sell it and there's no buyers. And so free market economics, if you go to the market and you sell anything, if you've sold anything on Craigslist, eBay, what have you, or your home, right? You advertise it, you have a price, you need the liquidity, cash, right? So I want to improve your liquidity, so as a government, I'll just buy it and print the money. That's what they're doing with these bonds. But in a free market, what you would do with your home, if you can't sell it, is, drumroll please, drop the price. When it comes to bonds, what you do is raise the interest rate to incentivize more buyers. Again, government can't afford it. Clown world, it's a clown world. And you're going to see more of this, where it's because the Federal Reserve, is raising interest rates, and the Treasury and the Federal Reserve are separate entities. The Federal Reserve is not part of the government. So it appears as if two entities, the Federal Reserve and the Treasury, Fed is selling, Treasury's buying. It doesn't make sense. So when your average person looks at this and like a little dog goes, huh? Right? What? That intuition is correct. This is jacked up, and they're becoming more desperate to keep this party going, and no one wants to be in the party anymore. And they're like, come on, it's fun, right? Yeah, aren't you guys having a good time? And everyone's like, no. And they're like, oh, we'll go buy more alcohol. No. Okay. It's falling apart, and it's falling apart mainly because of distorted incentives from the government and government debt. That's why. Okay, so you're going to see, when you filter it through that lens, you go, oh, they can't afford the debt. Makes total sense. They just print more money. They do off-balance sheet stuff. They make it up. It's Fugazi. Okay, further reading here. This idea means that the Treasury would sop up unwanted supply, meaning low demand. So they just provide the demand, as I said before, of off-the-run securities that have become harder to trade once they are replaced with newer Treasury issuance that have higher interest rates. I've said this before. It's sick what these people are doing. And all it does is, it just makes the problem bigger again. That's all it does. Prevents pain, prevents the free market from doing what it's supposed to do, which is, hey, if you have inflation, there's consequences to that inflation. If you have government debt, there's consequences to that government debt. And the government's solution all the time is just add more debt, delay consequences. My elections in 2 years, I cannot have the market fall apart. And so we're not in a free market anymore, if you're wondering, right? We aren't. We haven't been for a while. We are in this controlled government spending palooza, and everyone's just waiting for the math to kick in, because it's going to, right? I have talked about it on this channel, a death spiral. If you have debt on credit cards, for instance, let's say you've maxed out one and you can get another, right? And this next credit card is a lower interest rate than the first. Fabulous, okay? And let's say that conga line continues. Keep getting more credit cards, but the interest rate keeps going lower, much like the United States last 10 years, okay, with our national debt. The interest rate's lower, that means the debt burden's not as high. That train stops when A, people don't want to buy your debt or issue your debt in the form of credit cards, or B, they see that, hey, you might not pay this back, so they raise the interest rate. As long as that interest rate's dropping, you're okay. But now we're in a world where the interest rate's not dropping anymore. Why? Inflation. And inflation's the one problem that the government can't solve by printing money. Think about that. You're like, oh yeah. And think about the last 10 years. That's the one button they always push. Print money, print money, print money. But inflation's the one problem they cannot solve by printing more money. I think you're going to see more of this kind of clownery and trying to make it seem, and I've said this before, but central bankers and treasury secretaries and politicians cannot let the cat out of the bag. Meaning they cannot tell you, hey guys, this is real bad. And it's our fault. Because what happens is market participants run to the exits as soon as that happens. So they don't, you've maybe heard words like confidence and all that. A lot of it has to do with emotions. And if like a Fed chair or Janet Yellen, Treasury Secretary, come out and say, this is such a massive problem, we're going to have to implement all these measures, people run for the exits and make it even worse. So they're always going to be a salesman of the economy and how great things are and how they can fix it. That's always going to be the case. And take that with a grain of sand. That's all I'll say. Or grain of salt. Grain of sand? Salt? I don't know. Okay, anyways, grain of salt. Anyways, that's my thoughts on this article. I'll link it in the description below. Thanks for watching. Thanks for listening. See you guys in the next one. Peace.